Ladies and gentlemen, welcome back to another video. I'm your host, TheDividendAristocrat, and today we're going to be taking a look at my portfolio, and specifically we're going to be taking a look at my biggest individual stock within the portfolio. This week, the company did release earnings, so I want to cover how that went, but to give you a hint, they did very well in my opinion. Now, if you guys do enjoy this type of content, consider subscribing to the channel. I would really appreciate it. As a reminder, this is not financial advice, and I'm just merely sharing my opinions on this channel. Now, before we get into all that, let's start by taking a look in my portfolio dashboard. In total, I've invested $51,892 into the portfolio, $17,000 of which was done this year, and my current value sits at $68,230. That gives me an unrealized gain so far of $16,300 and a total return of about 31.48%. Now, I do have some realized gains from some stock selling that I've done over the years, and I do have plans to add that into the portfolio spreadsheet as well. In terms of dividends, we're almost at the $2,000 mark for dividend earns, and my yearly projected income going forward is $1,080 per year, which gives me a portfolio yield of 1.58%, or if we're basing it on my initial cost, it's 2.08%. In terms of holdings, we're currently at 21 different holdings with a cash position of under 6,000. This needs updating, but probably between 5 and 6K, and I'm trying to bring this number down significantly throughout the next year or two. Now, before we dive in and take a look at which holding of mine is the largest and how they did on their earnings, let's first take a look at this earnings calendar, and this is for this upcoming week's earnings. Now, the reason that I'm pulling up all these earnings right now to show you guys is if there's any stocks that you do want me to cover throughout the week after they release their earnings, some of them might not be here. They might be on the NASDAQ earnings calendar, but just let me know in the comments down below and I'll try my best to get to them. That way, if there's any interest in any particular company, I'd be happy to cover it, but if not, then I'll probably just skip this week's earnings. Now, the company that we're going to be talking about today is Alphabet, which is Google's parent company. So we'll take a look at what CNBC had to say about some of their earnings highlights, then we'll hop into their actual earnings report, take a look at some other metrics, and then we'll hop into my own position in Google so we can see how it's done so far and how large a position it makes up in my portfolio. So in general, in my opinion, Google did a very good job with earnings this time. I think they crushed it. They beat earnings expectations and they raised their spending forecast, which could be good or bad depending how you look at it. So for the key takeaways here, Google did report second quarter results on Wednesday that beat on revenue and earnings, which is fantastic. But the one thing here that got investors a little bit concerned is that they did announce that they're going to be increasing their CapEx spending for 2025 up to $85 billion, which is a $10 billion increase. Now, the reason that I'm not too concerned about that is because the reason that they gave investors so far is due to the strong and growing demand for their cloud products and services, which to me is a great reason to have. In general, the company's revenue did grow 14% year over year, which is significantly higher than the 10.9% that Wall Street expected. So taking a look at revenue and earnings per share, in terms of revenue, they made $96.43 billion, and that's versus their $94 billion expected, which is a pretty strong beat. And for the earnings per share, $2.31 versus $2.18 expected, which is also a pretty solid beat. Now, some other very important business segments are listed right here. For YouTube advertising revenue, they managed to beat on that, $9.8 billion versus $9.56 billion, which is of course amazing. And for their Google Cloud revenue, which might be their most important business segment right now, it made $13.62 billion versus $13.11 billion expected, which meant that they re-accelerated their growth, and that's fantastic. So right here, we can see them talking about the CapEx investments, and in February, it was announced that they expect to invest $75 billion into capital expenditures in 2025, and that already had Wall Street pretty shaken up. They were not expecting such a high number. At the time, they were expecting about $58.84 billion, and this was much higher than that. Now, investors were not too happy about that increase in spend, but now they announced even $10 billion more on top of that, going all the way up to $85 billion, which of course does not have everybody happy. Now, I completely understand that if the return on investment ends up being fairly low, then this will be a big fail in terms of CapEx spending. But if the return on investment remains high like it has in the past, then this can be a fantastic opportunity for the company. Right now, they're saying it's just to meet strong and growing demand for their cloud products. And if that's the case, then there's no reason they should not be investing as much money as possible as they can. Google has to stay ahead of the curve in order to continue competing with other companies and stay ahead of competition. And this is just one step they're taking to ensure that they can. Now, in terms of cloud computing, where they're saying a lot of this investment is going into, it grew 32% year over year to $13.62 billion, which really shows you that this is the fastest growing segment and one of the most important segments in Google's arsenal right now. Now, recently, OpenAI did announce that they expect to use Google Cloud infrastructure for its ChatGPT service, so it's a very good partnership for them to have. In terms of net income, it also increased 20% to $28.2 billion, which is very strong. And the search and advertising units still showed growth in the second quarter despite the competition from AI continuing to ramp up. Search was able to bring in a massive $54.19 billion during the quarter, and the advertising revenue grew to $71.34 billion, which is up about 10.4% from the year prior. Now remember, this is basically the most at-risk business segment for Google, so any growth here is fantastic, especially with the threat of AI. Now for their other bets units, which I don't care about as much, but it does include Waymo, which is pretty interesting to keep up with. It did bring in $373 million, which compared to their other business segments is very small, but it is up from last year, which was $365 million. Now at the same time, other bets are still not profitable for the most part. They did report a loss of $1.25 billion, which is up from $1.13 billion a year ago, so they still have a long ways to go to make some of these business units profitable. Right now, the initial investment for Waymo's is very high, and it takes a long time to start getting any meaningful return from them. So there's a couple things I'm going to keep track of going forward, and one of them is how quickly their expenses and capital expenditures are growing. In terms of operating expenses, it grew 20% year over year to $26.1 billion, so it's important to keep that in mind when looking at how much their earnings per share grew. If the growth of expenses outpaces the growth of their earnings per share, their revenue, their net income, then that's not a good thing. Going forward, they could see some tailwinds due to several reasons, including a negative impact for advertising, which had a strong 2024 because of the US election. So now hopping into their actual earnings report, here you can see the same information summarized. This is directly from Google's website. In terms of revenue, in both 2024 and 2025, revenue grew 14% year over year, and the fact that we're able to continue holding this fast rate of growth is fantastic. Now going forward, I do believe that revenue will slow down a bit, but if we can stay in double-digit rates, that'll be very strong regardless. Now the operating margin remains steady, and that makes sense. They're investing a lot back into the company right now. I do expect this to go up over time. Here we can see most of their business units broken up, and we kind of already covered it, but if you want to pause the video real quick, you can take a look at how it's been growing over time. The YouTube and Google search has been growing nicely, but Google Network actually has decreased over the past year. One thing I like to see is that their subscription services have been growing, which is good. These tend to be high margin segments of the business. Another thing to note here is the number of employees had stayed relatively flat. They did grow by 8,000, but for such a large company, this is not too bad at all, and they've been trying to keep their headcount low. Now, in terms of share repurchases, we can see all their share buybacks right here for each quarter. And the reason it has these parentheses around it is because these are negative numbers. And that just means that they're spending money in order to buy back shares. Now, as a shareholder, if they have the cash on hand, I want this number to be as large as possible, assuming that Google's stock price is trading at fair value and they're getting a good return on this buyback. So going up real quick, you can see this is quarter ended June 30th and then year to date by June 30th. And so in 2024, in both cases, they actually did buy more than right now, which makes sense. Google's stock price was a bit lower, I do believe. But going into this year, I'll be surprised if they don't start ramping up their buybacks, especially since they've been doing so well and the stock price has remained relatively low. Now, in terms of free cash flow, this is a pretty important metric, and you can see how they calculate it right here. They take free cash flow as the net cash provided by operating activities less capital expenditures. Now, the main thing we can see here for free cash flow is that from Q3 to Q4, it did grow pretty significantly, but then coming into 2025, it has been going down, especially in Q2 of 2025, it is down significantly. Now, the main reason for that is the extreme amount of spending on CapEx. Right now, Google is doing a heavy investment cycle back into the company. That's why they raised their expectations to $75 billion. And now they raised it even further to $85 billion. And that's going to hinder free cash flow growth pretty significantly, at least short term. Now, if these investments do play out, then over time, we can expect the free cash flow to explode and start growing very rapidly once again, but we'll have to see in 2026 and 2027 how that plays out. Right now, it's very hard to tell, and since they're expecting to put so much money back into capital expenditures this year and potentially next year, we'll have to see how they do with that, then it might mean that we have lower levels of free cash flow for a longer period of time. Now, this does not concern me at the moment. Like I said, we'll take a look at their ROIC later, but as long as they're getting a good return on investment, it's fine to have suppressed levels of free cash flow short term. These are still very large amounts at over $5 billion. Now, for some reason, I missed it and I skipped it earlier, but the only other thing I was looking for in here is stock-based compensation. That's pretty important for me to keep track of for a company like Google, since they do tend to have stock-based compensation. It's a bit on the higher side compared to some of their competition. Now, the reason I like to pay attention to this is because it's technically something that eats into free cash flow, even though it's not as obvious initially. So this is for quarter ended June 30th, 2024 and 2025 right here. So we can see that over time, it stayed relatively flat for both quarters. So I'm pretty happy with that. And the same can be seen for year to date. We had $11 billion in 2024 and $11.5 billion in 2025. So a slight increase, but nothing to be alarmed about in my opinion. What I'm seeing here is that they're able to continue bringing in new talent and retaining old talent without having to increase their stock-based compensation too drastically. So hopping into my portfolio holdings section, we can see all my holdings right here, and I organized it from my highest allocation to my lowest, and we're going to zoom all the way to the right in order to take a look at that. So right now, VOO is my single largest holding, but this is an ETF that tracks the S&P 500, and I want it to be a large portion and foundation of my portfolio, so that makes sense. Now, in terms of my individual holdings, in that case, Google is significantly larger than almost every other investment in my portfolio. We have SCHD, which is also an ETF, pretty close behind it. And then we have Uber relatively close behind it at 8.8%. But after that, it drops down significantly, with Booz Allen Hamilton being only 5.4% of my portfolio. Now, for the most part, I don't want too many of my positions being much over 5 to 8% of my portfolio in the long run, but for the short term, I'm okay with Google making up 10% of my portfolio because I believe that over time, I'll be able to add into other positions and fix my allocation. In this case, I think Google was just too good of a bet not to dump more money into it, and so I was willing to take the risk and make it an oversized position, at least short term. So filtering out and taking a look at Google on its own, we can see that my average price paid was $146.22. Now, the way that price is calculated is using my order history tab. So right here, you can see all my orders that I've ever made for Google stock. In 2022, I was buying the company at ridiculously low valuations. I had some shares here at 102, 98, and 97.50, and the company's stock price continued to dip down, and I really wish I would have bought more. You can see right here that it continued dipping down all the way to 93.55 and then 85.32. And if I had loaded the boat during this time right here on Google and gone really overweight on the company, my returns on it would be absolutely phenomenal. On the average price of these initial shares, I should be over a double of my performance in the company, but since then I have raised my cost basis up by buying more shares. Now, to me, that's no big deal. You can't just buy a company once and then hold it for 10 years and hope to be a millionaire. You have to have large enough positions in your portfolio for it to be substantial enough. Now, in my case, I thought there were some other good buying opportunities throughout the past year to 2 years, and because of that, I've continued adding into the position. You can see that I went from November of 2022 all the way until September of 2024, and I had not bought any more shares that entire time period. At this point, I started buying back into the company. I bought some shares at 150, which is a pretty good price, 167, which is a little bit on the high side, and then it dropped back down to 160, and I continued buying more shares. Now, some of these purchases were scattered over a couple month-long period, and the tariff dip was basically the last time I purchased any more shares of Google. I took advantage of that pretty significant dip in the company's stock price, and I bought a good amount more of shares. Now, going into 2025, I knew I wanted to add more into my Google position if there were any opportunities, and right now it's the largest stock purchase I've had in the entire year. If you guys want to see my 3 largest purchases in the portfolio this year so far, I'll pin the video right up here, but I did post it last week, so either check the pinned video right here or at the end of the video, I'll leave it there as well. So far, I believe Google was my largest purchase of the year. In the past 6 months, I put over $3,000 into the position. Now, to me, it presented an excellent opportunity, and I was really hoping here that it would continue to dip down in price so I could scoop up even more shares. A lot of times you'll see that for long-term investors who have good faith in the company, they'll want to see lower stock prices short-term so that they can build large positions in the company, and then over time they hope the stock price will rise. I have that same mentality. I'm not in a hurry for Google to be worth $300 per share. The longer it stays low at these 140 to 150 levels, the more I can accumulate, and then when it does hit $300 per share, it'll be a much bigger difference in my portfolio value. So at this point, I was hoping to buy more shares if the company's stock price did dip down, but it did decide to start recovering, which I'm totally fine with. My position is already a little bit overweight, and I'd like to keep it that way. Now, if you guys have made it this far into the video and are enjoying it so far, all I ask is that you leave a like. It does help me out a ton. So the current price is at 193, and because of the recent earnings, the stock price has actually recovered pretty significantly, and I am still pretty happy to see that, even though it means I'm likely to not buy any more shares at these current levels. In terms of shares purchased, I purchased 35 shares, and Google has recently initiated a very small dividend, so I've reinvested that to get 0.091 shares more of the company. Now, in terms of how much I have invested so far, I invested $5,100 into the position, which for me is a relatively large amount, and my current value sits at almost $7,000, which gives me a total return of over 32%. Now, a lot of this return happened recently, but I can't complain too much. It is now a very substantial position in my portfolio with some pretty good performance. I've earned $15.77 in dividends so far, but going forward, I'm expecting it to pay me 29.48 cents per year, which I'll be reinvesting all of it back into Google. The yield on the company is very low. I think they pay 20 cents per quarter per share, so 80 cents a year, so that's 0.43%, or a yield on cost of 0.57%. Now that I think about it, they actually did increase their dividend this year by either 4 or 5%, so it's a little bit larger than that. It's 84 cents per year. Now, in terms of performance, we can pull it up on Google Finance right here. So the one day doesn't really matter that much, but in the past 6 months, you can see it's been all over the place, and we're actually flat for the past 6 months because of that. The company's stock price was trading at 52-week highs at some point at 206, and then because a lot of negative news and a lot of negative sentiment around the company regarding both AI and also some of their DOJ probes and lawsuits, the company's stock price, including the tariff dipped down pretty significantly at about 30%. Now, since then, you remember my cheapest purchase was about 141, so pretty close to here. The stock price has recovered pretty significantly at up over 33.5% from the bottom. In the past year, the company is up 15.68%, so not bad, but not as strong as some of its peers. But in the past 5 years, they performed amazing at over 156%, which is significantly more than a double on the position. Now, I began purchasing my shares around here. That's when you saw those prices of between $100 and about $90 per share. So I took advantage of this dip that we had in 2022 and early 2023. Now, it's really not trading that ridiculously in terms of valuation. It's trading at about a 21 price to earnings ratio and growing pretty quickly right now. So I don't think it's that bad of a risk if you want to start a position in the company. But for me personally, I'm going to wait to see maybe if the price goes down, I'll add more, but otherwise I'm happy with the current position size. So the last thing we can take a look at here before ending the video is some of their financial metrics. So you can see right here, the revenue per share has grown incredibly fast over the past couple of years, and the same can be said for EPS and free cash flow per share. Now, I expect this free cash flow per share to start stagnating or even drop this year, and that's because of the heavy investments that we did see, but regardless, the company's been performing very well. In terms of shares outstanding, they began buying back a decent chunk of their shares, so we're starting to really chip into those shares outstanding, and their free cash flow versus stock-based compensation is a pretty important graph to look at. As I was mentioning earlier, stock-based comp makes up a pretty big portion of their free cash flow, and so I like to take that into account. So because of that, it's important to make sure the stock-based compensation is not outpacing the growth of free cash flow. Now, if for the next couple of years, free cash flow is a little bit suppressed because of those investments, then I don't blame them too much, but as long as stock-based compensation at least remains relatively steady. Now, the dividend per share graph looks weird, and that's because the dividend was initiated in 2024, so it's the first year of dividend history, and over time, this graph will begin to fill out as we get new years like 2025, 2026, etc. Their net income margin is pretty high at almost 30%, but their capex has began to peak, and 2025 is probably going to be a ridiculous year at between, I'd guess, $70 to $90 billion of capital expenditures. Now, the most important thing to look at here, though, is their ROIC. Basically, how much of a return are they getting on their invested capital? So that's kind of like the money they're investing through capex, and right now it's extremely high at over 20%. Now, if they're able to keep this ROIC at over 20%, then I think that there's no reason they shouldn't be investing as heavily as they can into capex. As always, that does bring us to the end of today's video. I really hope you guys enjoyed taking a look at my own position in Google and how they've done on their recent earnings report. In general, I personally think that they did a fantastic job on this quarter's earnings, and we'll have to see how they do for the rest of the year. If you guys did make it this far into the video, comment down below whether or not you have any shares of Google, and if not, let me know if you are planning to buy any at some point in the future. If you haven't yet watched last week's video where I go into detail of which 3 stocks I've been buying the most of in 2025, check out this video right here. And if you want to see the video before that where I talk about a Magnificent 7 stock that I recently sold out of, check out this video right here. Remember, the best time to invest was 10 years ago. The second best time is today. I want to thank every single one of you guys for watching, and I will see you in the next one.